The market is finally starting to look cheaper in late March 2026, but cheaper isn't the same thing as safe. Right now, we have war headlines and higher oil, former winners getting sold hard, gold behaving strangely, and Bitcoin still acting like risk. It leads to one simple question: should you buy this step or protect capital? Here is the sharp answer. This is not an all-clear dip, but it is also not a no-touch market. If you want to act, rule number 1 is to buy simple first. That means index exposure before single names, and leverage belongs clearly last. To see why, you have to start with what actually changed in March, not with opinions about what should bounce. Start with oil, because this is where the story shifted from headlines to physical reality. On March 10th, the EIA projected that Brent would stay above $95 a barrel for the next 2 months. That was the warning. But by March 27th, the IEA reported that exports through Hormuz had actually fallen below 10% of capacity. They also triggered the largest emergency stock release on record. That matters because it turns a price forecast into a physical supply shock. It isn't just headline risk anymore. It is a physical transmission story. Now layer in the inflation backdrop. February CPI came in at 0.3% month-over-month and 2.4% year-over-year. That is not a 2022 replay, but it is not low enough to make renewed energy pressure irrelevant. On March 18th, the Fed noted that inflation remains somewhat elevated, and median projections for 2026 now sit at 2.7% for PCE. At the same time, yields moved hard. Between March 2nd and March 27th, the 10-year rose from 4.05% to 4.44%, while the 30-year climbed from 4.70% to 4.98%. This is the mechanism. The market is not only reacting to fear, it is reacting to the math of a repriced discount rate. Before we look at specific vehicles, let's be strict about what the evidence actually proves. The data confirms an oil shock and a restrictive rates backdrop. It also proves that volatility is elevated and market structure remains fragile. But here is what the evidence does not prove: a recession, stagflation as an established fact, or a systemic credit event. The cleanest label for this moment isn't panic, and it isn't all clear. It is an inflation risk and rates reset regime. That distinction matters because uncertainty alone is not bearish evidence. It is simply the math of a repriced market. So here is the lead view. This is not an all-clear dip, but it is also not a no-touch market. The base case is a messy reset. It is a regime where relief rallies are likely enough to matter, but where the burden of proof is still higher than in a normal correction. As the scale shows, the mistake is letting uncertainty become a default order to hide. If you turn every unresolved signal into a reason to hide in cash, you can miss a broad beta rebound that the evidence does not actually rule out. The sharpest practical takeaway is simpler. If you buy simple first. Let's look at the actual damage to market structure from March 2nd through March 27th. SPY fell 7.62%, and the QQQ fell 7.48%. That tells you this wasn't just a tech problem. Broad beta took real damage across the board. But the standout is that TQQQ number, down nearly 22%. With the VIX closing at 31.05 on March 27th, leverage wasn't just a stronger version of the same thesis. In this kind of high volatility tape, daily reset leverage becomes its own risk factor, punishing timing errors much more severely than a simple unlevered position. The former winners people usually trust to hold up in a dip did not protect capital this time. Between March 2nd and March 27th, Microsoft fell 10.48%, Alphabet dropped 10.5%, and NVDA was down 8.2%. Even Robinhood, which we use as a signal for retail risk appetite, fell 16.2%. This is the core of the problem. Strong fundamentals or simply losing to macro repricing. It doesn't mean these businesses are broken. Microsoft still has Azure growth, and Alphabet still generates massive cash. But micro-level strengths were overwhelmed by the macro gravity of higher discount rates and massive capex burdens. When you layer in deteriorating breadth and conflicted ETF flows, it confirms a stress tape, where even high quality isn't enough to hide from a systemic reset. If you are looking to re-risk today, the question is where to start. The cleanest move is not a hot single stock, and it is definitely not TQQQ. You start with the index, specifically SPY or QQQ. SPY is the cleaner default here because it offers broader exposure with less concentration risk. QQQ is a valid alternative, but only if your specific thesis is that megacap AI and cloud leadership will be the first to regain traction after this reset. Either way, the principle is the same. You prioritize broad, simple, and unlevered exposure before you even think about picking individual names or reaching for leverage. We have to be very specific about TQQQ here, because it does not belong in that default re-risking bucket. The most common mistake is treating it like a faster version of the NASDAQ 100, but in this environment, that framing is just sloppy. When the VIX is above 30, the daily reset mechanism creates a severe timing penalty. It means your entry has to be near perfect, or the reset math will punish your timing errors much more harshly than if you were holding plain QQQ. This isn't about whether TQQQ can rally. It can. It is about the fact that high volatility leverage is a separate category with its own risks. That is why in this playbook, leverage belongs clearly last. Individual names still matter in this playbook because they help explain the regime. Take Microsoft. It's arguably the strongest second-order case we have. Cloud revenue and deserved growth are robust, and the business is well diversified. But even with those fundamentals, the stock sold off materially. The reality is that margin pressure from AI infrastructure spend is real, and the market is repricing for it. Alphabet follows a similar logic. You have strong cloud growth and massive cash generation, but that's being weighed against a heavy capex burden. It stops being a simple, cheap quality story and becomes a bet on productive capital allocation. These names aren't failing as businesses. They're just demonstrating how even the best balance sheets are struggling to protect capital against this macro repricing. NVDA is the clearest example of how a higher discount rate can overwhelm even the strongest fundamentals. The business is still delivering powerful operating results, but that strength wasn't enough to protect the stock from valuation pressure. In plain English, the fundamentals looked great, and the discount rate still didn't care. Robinhood is useful here too, but more as a signal for retail risk appetite than as a default case for buying the dip. Its story is still heavily dependent on sentiment and trading activity. Finally, if you look at Bitcoin and the IBIT ETF between March 20th and the 27th, they behaved strictly like risk assets, not hedges. These names stay in the research because they help define the regime, but they don't beat the index first case by default. Now we flip the framework entirely. If you aren't looking to buy risk right now, you have to be clear about what actually counts as defense. On this side of the ledger, the number one tool is simply cash and patience. That's a legitimate position, but it needs to stay in the defense category. It isn't proof that the market is uninvestable. It's just a tactical choice. The trap to watch out for is letting your defense toolkit quietly become your ranking for buying the dip. As the evidence from late March showed, with Bitcoin behaving strictly as a risk asset rather than a hedge, re-risking and defending are two completely separate questions. You have to keep those playbooks distinct. Gold is interesting because it actually failed that first clean safe haven test. It sold off right along with everything else at first. It only started to differentiate later. On March 27, we saw both GLD and SLV move higher, even as equities continued to slide. That tells you gold is better understood as delayed or conditional insurance, rather than a guaranteed same-day shelter. Silver can play a role here too, but keep in mind it is more cyclical and carries more conditions than gold. Finally, to be very clear, Bitcoin still does not belong in this defense bucket. In this one-month framework, the crypto evidence shows it is still behaving like a risk asset, not a hedge. Let's simplify the next month into a working map with 3 branches. This isn't about fake precision. It's a way to weigh where the evidence actually points. The base case is the messy reset at 50%, a scenario where volatility persists, but the macro story doesn't fundamentally break. There's a 35% weight on a buyable correction or relief rally, where some of the March pressure starts to vent. That leaves a 15% weight on a broader bearish regime. While that bearish tail is a real risk, it is currently not the center of the evidence. So, what actually changes this call? For a relief rally upgrade, you need to see oil cool back below that danger zone, long yields retrace part of their March surge, and breadth expand beyond a few narrow leaders. In our base case, oil stays elevated but flat, yields remain highish but stable, and markets stay sensitive to every headline. But for the call to break bearish, it takes more than just fear. You would need to see oil spike even higher, the 10 and 30-year yields keep climbing, and private credit stress starts spreading beyond these currently contained products. Watch oil first. The threshold to track is $95 to $100. If Brent moves decisively back below 95, the bullish relief case gains structural support. If it pushes toward 100, the macro friction increases. Next, check the 10-year yield. We are looking for a move toward 4.2% for relief, whereas a push toward 4.6% makes the tape significantly harder. For market structure, look for steady demand in broad indices like SPY and QQQ. If the bounce is driven by leverage-heavy chasing, it's likely fragile. On the credit side, watch for continued containment in vehicles like BCRED. You want to see localized stress rather than wider spillover or proration. Finally, watch the quality of leadership. A healthy recovery requires Microsoft, Alphabet, and NVDA to stabilize, alongside improving breadth, rather than a speculative bounce led by names like Robinhood. Bottom line, if you're already invested, don't mistake a first bounce for a full regime repair. You'll want to see oil, yields, and breadth stabilize before adding aggressively. If you're sitting on cash, you don't need a heroic bottom call to get back in. The tactical blueprint for April is simple. Buy simple first, stay broad and unlevered, and let the evidence earn your confidence. If this framework helps, like the video, subscribe, and follow the Daily Digest for the shorter updates between deep dives.